194, you have a summary of all the debits and credits for all merchandising operations. I'm going to go through the other slides today fairly quickly. Let me just close the door. It's the same chapter. Most of the stuff is repeated. We're just going to go through the examples. Again, merchandising operations. We're going to focus on examples here and examples over here. Merchandiser, you got, I was explaining last time, wholesaler, retailer, consumer. We already did that. We have, it's called sales revenue, which we use for short sales, okay? Just because it's short and easy, but you have to understand that it's revenue, and it's a sales revenue, okay? Income measurement, you take the cost of goods sold, you get the gross profit, and then you have the operating expenses, and you get to the net income. This is associated with the multiple step income statement. The operating cycle, I was explaining before, the simplest, easiest, that's why we studied the first 4 chapters, is a service company. It's got, you see, only 4 steps in the cycle, or 4 stages. Here, you got 6 stages. You buying the inventory, and then merchandising inventory, and they have to sell the inventory. So you got 3 steps associated with the extra steps associated with the inventory. You got to buy it, you got to store it, you got to sell it. And you have 2 types of system. Perpetual system, I'm not going to go through it, already covered. And in the periodic system, ending inventory you determine by physical count. You go in the store, come on girls, okay? You go in the store and you count how many shirts, 20 shirts, you write. How many ties, 15 ties. How many pants, 10 pants. You just count how many you have. And we go to the reporting purchases of merchandise. Let's get to the example. So when you're buying, you have what's called purchase invoice. When you're selling, it's called sales invoice. And here's a simple example. On April 5, purchased merchandise from Bryant Company for $25,000, terms 210. So debit becomes merchandise inventory. So the main account is called merchandise inventory. Merchandise inventory. And merchandise inventory is an asset. It is the same as equipment, same as office supplies. So it should be debit merchandise inventory, 25,000, and then you're going to have credit account payable 25,000. So debit merchandise inventory 25,000, credit account payable, accounts payable 25,000. That's it. That's how you record a simple purchase. Next, you should add if there is freight. So you pay extra for the freight. We call this freight in or transportation in 900. So it's going to be debit again, merchandise inventory, and credit. If you pay with cash, it's going to be 900 cash. Okay. So debit merchandise inventory. If it's payable, you say account payable. If it's cash, you say cash. So credit, cash. Credit, cash, 900. Okay. So you add the merchandise inventory, you add the transportation to the merchandise inventory as a debit. Okay, so increase the cost. Next one. On April, purchase equipment from account for 26. This is an example that not everything which you buy becomes merchandise. So, this is example, not all purchases increase merchandise inventory. You can purchase insurance, it's not in the inventory. You can purchase equipment, it's not part of the inventory, meaning of the merchandise inventory. So, merchandise inventories, if you buy something for the purpose of selling. If you buy water for the purpose of drinking, not the merchandise inventory, it's supplies. If you buy, let's say, coffee and you plan to drink it, then it's supplies. If you buy coffee and for the purpose to sell to customer, then it is merchandise inventory. So here you need to understand that you don't just put everything in merchandise inventory. If you buy equipment, you say debit equipment, credit account payable. Debit equipment 26,000, credit account payable 26,000. All right. I already explained FOB shipping point. Okay. If that's the case, buyer pays for the freight cost. If it's a FOB destination, seller pays the freight cost. And you notice that freight costs are incurred and whatnot. For the seller, we call them freight out. Freight out, or it's called delivery expense. This is the name, freight out or delivery expense. Okay, I already explained purchase return. Okay, I already explained purchase allowance. So return goods for credit, or the seller will grant allowance. Allowance means deduction or reduction from the purchase price. That's already clear. Trying to get to the examples. Okay, example. On April 8th, returned damaged merchandise to Ryan Company and was granted 4,000 credit on returns. So you returned and you were granted 4,000 credit. So in this particular case, before you debit merchandise inventory, now it will be credit merchandise inventory, and you're going to have also, before you had account payable 25,000, now you're going to have debit account payable. So you will reduce the amount of account payable by 4,000. So you're going to have debit account payable, debit account payable. So debit account payable, 4,000, reducing the amount of account payable, and you're also going to have credit merchandise inventory, 4,000 merchandise inventory. So when we purchase, we say debit merchandise inventory, credit accounts payable. Now, when you have allowance, you do the opposite. You say credit accounts payable 4,000 and merchandise inventory 4,000. Now, the balance on merchandise inventory is 21, meaning 25 minus 4. And the balance on accounts payable is again 21, which means 25 minus 4. All right. So you can get purchase discounts. Okay. So this one is read 210. That's how you read it. 210, and then you say net 30. So this is a 210 net 30. This is how you read it correctly and properly in English. 210 net 30. I already explained this in the previous. And here is a new one. This one is familiar. 210 net 30. This one is 1 10 year month, EOM. EOM stands end of month and is interpreted as 1% discount if paid within the first 10 days of next month. So, within 10 days after the end of the month. So, within the 10. So, by number 10, on the 10th, you have the discount. So, 1% discount if paid within the first days. Here is net amount due within the first 10 days of the month. So, you have to pay the full amount by the date of 10, on the 10th, basically, within the first days of the next month. So, that's a new symbol, but that's how it's interpreted. EOM means end of month. Next one. Okay. Next one. Paid within the discount period. So, on April 15, the amount due was paid in full. Remember, there was already 4,000 returned. So, original price, 25,000. Discount 4, amount 21. And now you calculate 2% of 21,000 and 2% of 21 is 420. So 420 is going to be the discount. So if you're going to be making, in this particular case, let's see, pay the full amount. Now see what happens. Account payable, 21,000. You will clear all account payable. And you're going to pay cash 21,000 minus the discount. So we're going to say credit, discount 420, and then it's going to be credit cash 20,580. 20,580. Yes. So you're going to have credit purchase discount and cash. Cash 2580, and now we're going to have purchase discount, or instead of purchase discount, you can put it directly into merchandising inventory. So you can put it as a purchase discount, and then you close purchase discount in merchandising inventory. Or you can put it directly in merchandise inventory, meaning you will lower the merchandising inventory value by 420. Yes? Slowly. On the board? Okay, well, it's here in this particular case, it's written. So before you have 25,000, that's the original purchase price. Purchase, we say invoice. After that, you have 4,000 was the allowance. So now the net price becomes 21. This is the net price. But now you have to net it of discount. Discount is 420. And the discount is simply 2% multiplied by this net price, 21,000, which is 480. And the difference of 2580 is cash. So you're going to have credit cash 2580, credit the merchandise inventory 420, and this is the account payable net price, the same as due Amount. Sometimes we say amount due. The amount of money which you owe on your account payable. Well, that's it. That's the example. Debit account payable. So no more owed amount on account payable, and you cover with cash and put the discount in merchandise inventory. Okay. All right. Now, what would the entry be if the company failed to pay within 10 days? So, they paid it, but after 10 days. If that's the case, you're still going to have debit account payable 21,000, and credit will be cash 21,000. Cash 21,000. All right? No discount. Discount 0. So you paid everything cash. That's all. And let's try a few more examples over here. Oh, okay. What would happen if there was, okay, should discounts be taken or not taken? And we say if interest rate is 10%. If interest rate is 10%, you finance 21,000. And 21,000 at 10% for 20 days is 115 interest. So if you had to borrow the amount of money, okay, you would get 115. Instead, if you take discount, you will get a 420 discount. So the answer is it is cheaper to borrow the money, pay the 115, and get the discount of 420, and you save $304. So it is cheaper to pay early and get a 400 discount. That's simple. So you should usually calculate in business if you should take a discount or not take a discount. If you take a discount, you calculate how much is the discount. If you don't take a discount, you see what's the alternative. So you just calculate what will be the interest you would pay to take the discount, or you don't pay interest, you don't take discount. Okay? In this particular case, it is very profitable. You save $300 for not paying. And here is how they calculate the 115. They say, okay, 2% for 20 days, it's 36 days, or simply 2% you use on $21,000 for 20 days. Maybe you want to calculate this one, right? Calculator, iPhone. So you just say $21,000. You multiply by, it's going to be, let's see, 2% rate on the use of $21,000. Okay, let me see, let's do this. 2% for 20 days. All right, let's do this. 2% times 20 days. So you have 360 days. And this is for 20, okay? So it goes like this. 20 days, 2%. 20 more days, you pay 2% again. 20 days, you pay 2%. 20 days, you pay 2%. So, for a total of 360 days, you're going to pay a total of what percent? 2%, 20 days. 40 days, 40%. 60 days, 60%. 100 days, 10%. 200 days, 20%. 300 days, 30%. 360 days, 36%. Okay? 36%. And here the calculation is 36.5. Why? because they said, oh, the year, they say the year is not 360 days, the year is 365 days, and 365 days will mean 36.5%. Okay? So, the discount when you get is the same as getting 36.5% interest. Okay? It's a big interest on your money. So, you are effectively saving 36% annual interest. Yeah. Another way to calculate is 365 by 20, which is 18 periods, and you multiply by 2%. The same thing. All right.
I don't get this discount of 2% on 21 dollars. Okay, but then the second one is 21 invested at 10% for 20 days.
Yes. If you have, for example, you can invest it at 10%. If you invest 21,000, you invest 21,000. If you can get the money and invest it at 10%, a 10% annual, this means that the annual interest is 2,100 annual, okay? So for 1 year, you make 2,100. Well, how much are you going to make for 20 days? Well, for 20 days, you have to multiply by 20 and divide by 360, or divide by 365, whether with what kind of year. So, you cancel this 2 with this, you cancel this 2 with 36 becomes 18, so become equal to 2100 divided by 18, alright? So, now we divide by, what is it? Calculator, iPhone?
160.66. 160.6667.
160?
Yes, 16.
16.
16.
Yes.
Okay, 116 and
66.
Okay, and here they have 11507. So let's now recalculate. If it's 2,100 multiplied by 20 divided by 365. What is the calculation now? iPhone?
115.0684.
Yeah.
115.068, which is rounded to 115.07. So you divide by 365 is 115.07. So now camera back. 21 at 10% for 20 days is 115.07. It's the same
So we
amount.
try to figure out which one is more.
It's cheaper. Which one is cheaper? So it's cheaper, meaning better. You save more money by getting the discount. That's all. You save 4 times more money. It's good money. It's $300.
Let's say in the home, I don't know whether we have to calculate this. Do we use the year of 365 or 360?
Well, whichever. The difference is how much? The difference is $1. No big deal. It's a small difference. Whether you calculate the 360 or 365, the difference is between 115 and 116. So the difference is less or about $1 a 100. It's a small difference. So here, the difference is $1 per 100, and here it is 300 difference, okay? So whether you calculate on 360 or 365, doesn't matter. It's not important. It's important to get the big numbers, right? Don't worry about the small numbers. So we get down to the debits and the credits. But first, you got the debit 25,000, that's the invoice price. Then, or the purchase price. Then you got credit 4,000 to return. Then you got the debit freight in of 900. And then you got the discount of 420. So, you see how debit increases, credit decreases, credit decreases, net debit balance 21,480. And that's what you paid in cash. 21,480 was the cash payment. Okay? It's the cash payment. Let's see, there's a few more, one more example which you can go through. Okay, selling inventory. When you sell inventory, I gave you as an example, as a theory that you have two separate records. So, yeah, it's a paired record. You're going to first record the sales revenue, the selling price, which is cash or account receivable, depending on how you pay for it, or how you get paid for it. And then is the cost of goods sold, which is the expense side. So you have the revenue side, and you have the expense side. On the revenue side, you got account receivable, which you'll collect later in cash. And on the expense side, you have cost of goods sold and merchandise inventory. So the inventory becomes expense, and cost of goods sold is an expense account. And examples are coming. Alright, so this is the last example for today. You got three separate transactions. Some of them will require maybe 2 pages. So, Wheeler Company sold 500,000 of merchandise to Hashmi, terms 210, Form 30. The cost of merchandise was 350. So, you will have now, let me get this up right here. And we're going to check later on. You have it over there. So you just look at the pattern over here, and the pattern is account receivable, sales. So account receivable is going to be which date? Is it December? Which month? December 3. December 3 is going to be account receivable, debit account receivable, 500,000, and credit is going to be sales. $500,000. And it says the cost of merchandise sold was $350. So cost of goods sold. We like to shorten like this. Cost of goods sold is $350, and that's merchandise inventory credit. Merchandise inventory, $350. So that's the debit account receivable, sales, cost of goods sold, merchandise inventory. Now we go through next one, December 8th. For December 8th was granted an allowance of 27 for merchandise purchase. So December 8th. So for allowance, we say, let me see what was for allowance. We're going to credit merchandise inventory. Oh, no, you give them allowance. So it's going to be sales, purchases, and allowance. Now open your book on the page. Page is 194. And on 194, you see on the left where it says sales, okay? And for sales, you say granting sales returns and allowance. And you say debit sales returns and allowance, credit account receivable. So debit sales return and allowance, sales return and allowance 27,000, and credit account receivable you reduce from 500 becomes account receivable 27,000. You reduce by 27 the account receivable. Before we credit, now we debit. And the last piece is on December 13, Wheeler Company received the balance due. So December 13 received the amount due. So you're going to have some cash. Okay? You're going to clear out the account receivable, and there's going to be some sales discounts. Let's see now for a discount, for payment. Now, you look guys over here, you see receiving payment within the discount period. It's here on sales. And it says debit cash, debit sales discount, credit account receivable. So sales discounts. Sales discounts. Now, what is the account receivable? The account receivable is 500,000 minus 27 is 473,000. That's credit. 473, which is credit. Now, we need to calculate the sales discount. And sales discount is 2%. So, now you need to calculate, calculators, iPhones, what is 2% times 473. You need to do this for 2%. And for 2% it's going to be 946 is the discount. 946. 2% times 4 is 8, 946. Sales discount. 9,460. 9,460. And then the cash is, sales discount is debit. 9,460 is here. 9,460 is a debit, and cash is how much? The difference between these two is 463. 463, 540. Okay? So it is this minus this is the cash. Okay? And now we're going to go through to check that. So this is the first one, this is the second one, and this is the third one. All right. December 3, account receivable 500, sales 500, credit sales 500. So this one is good, right? This one is okay. Next, cost of goods sold 350, merchandise inventory of 350. That's okay. Next. They have some explains in this one. Sales returns and allowances 27. Account receivable 27. You see, debit, sales returns and allowances 27. Account receivable credit 27, which is exactly the same. Now, if it was returned, you also have to reverse the merchandise inventory. That's an extra step. So if it's allowance, you have only one entry. If it's a return, now you have to increase the inventory back. So you have to debit the inventory with the value, which is the proportionate value. Don't want to get into this now. Merchandise inventory, and you will have to inverse the cost of goods sold. That's not interesting. And let's get to the last piece. And the last piece is December 13. Cash. 463,540, which is the same as 463,540. Discount 9,460. Discount 9,460. And account receivable 473. And you get to see 473 comes from 500 minus 27. That's what we compute first. Then we compute this number, which is 473 times 2%. You calculate the discount, and then you calculate the cash amount. Okay? And that's how it's done. And you have some basic income statement. These were the sales minus sales returns and allowances, and these are the net sales. And from the net sales now we gotta get the cost of goods sold. Let's see. Okay. Closing entries, I don't want to go into that, okay? So, that's pretty much I'm done for today. We are all the way to slide 38. At home, you can go through the rest of the slides, and you need just to remember this is the summary over here of all purchases and all sales. How you record purchases.